All right, today we're going to connect the dots. We're taking publicly available data from the COMEX and weaving it into a very clear, very direct warning for anyone holding precious metals. We're going to piece together the story that this data is screaming, a story that most investors seem to be completely missing right now.
And let me be perfectly clear right from the get-go. This is not speculation. This isn't hype or clickbait. This is a serious warning, and it's built entirely on hard data, numbers that are updated every single day for the whole world to see.
My name is StackEgg, and that's exactly what we do here. We look at the facts, we follow the logic, and we ignore the hype. So, with that said, let's dive right into the data.
We're going to start with silver because there are 4 critical signals that are all flashing red at the same time. Any one of these would be a big deal, but seeing them all together, well, it's painting a picture of a market setup that is unlike anything we've seen in modern history. Okay, signal number 1, a jaw-dropping 86% of the registered silver inventory in the COMEX vaults is gone. Now, if you're not familiar, COMEX is the big leagues for metals trading, and registered inventory is the metal that's ready to go, the stuff that can be delivered immediately to close out a contract. And 86% of it has been drained away, leaving just 21 million ounces.
Now, here's where it gets really wild. You have to compare that tiny pile of physical silver to the mountain of paper promises sitting on top of it. Right now, for every single physical ounce of silver in those registered vaults, there are 38 paper claims, 38 contracts promising delivery of that same ounce. That 38-to-1 ratio, it's the most lopsided, the most extreme imbalance we have ever seen on the COMEX, ever.
Signal number 2 is all about demand. In just January and February, a massive 74 million ounces of silver were pulled out for delivery. Now, think about that for a second. That's more than 3 times the entire remaining registered stockpile being demanded in just 2 months. It's the highest 2-month delivery total in modern COMEX history. You've got record physical demand crashing head-on into a nearly empty warehouse. So the logical question is, why don't they just move more silver from the eligible stockpile over to the registered one? Eligible silver is metal that's good to go. It just hasn't been officially earmarked for delivery yet. And that brings us to signal number 3. The people who own that eligible silver, they're not moving it over. The conversion rate is slowing to a crawl. Why? Because they know what they're holding. They understand that their leverage, their ability to name their price, goes up with every single ounce that leaves the registered category. And our 4th and final signal, lease rates are rising. The cost to borrow physical silver is ticking up. This puts a real squeeze on anyone betting against silver, the short sellers. Their costs are going up, and it's forcing some of them to close out their positions by buying silver, which, of course, just adds even more buying pressure to the market.
So, what's the takeaway when you put all 4 of these signals together? The depleted inventory, the record demand, the slow replenishment, and the rising costs for shorts? It all points to one unavoidable structural conclusion. The physical silver market is tightening like a knot, heading for a breaking point. And the paper price you see on your screen, well, it hasn't even begun to reflect this reality.
Okay, so if the physical market is really at a breaking point, how does this all play out? What happens next? Well, based on this data, we can actually map out a pretty logical sequence of events for how this repricing is likely to go down. It looks like a 3-step process. First, the stress in the delivery system becomes so obvious that even the mainstream financial media has to report on it. That's when the real fun starts. Second, the owners of that eligible silver start demanding massive premiums to move their metal into the registered category, setting a new, much higher floor for the price. And finally, step 3, the paper market is forced to wake up and smell the coffee. The algorithms, the traders, they have no choice but to chase the price up to match the physical reality.
And look, this isn't some kind of crazy theoretical fantasy. This exact pattern, where the physical market quietly tightens and tightens until it suddenly forces a violent repricing in the paper market, it has happened before. We've seen this exact sequence play out in other huge commodity squeezes, from copper to uranium to natural gas.
But here's the most important takeaway on this: the urgency. When you do the simple math, you look at the rate the inventory is draining, and you compare it to the record pace of delivery, this isn't some problem for years down the road. We're talking about a time frame that's measured in weeks to months.
Okay, now let's pivot and talk about gold for a minute, because the data from the COMEX is flashing a totally different kind of warning signal here. For gold, it's not about a physical shortage, it's all about positioning.
This quote really says it all. Right now, positioning in gold futures is what you'd call a very crowded trade. It means that almost every big player, the hedge funds, the institutional traders, who wants to bet on gold going up, they've already placed their bets. The problem is that leaves almost no one left to buy. The marginal buyer has vanished.
And that creates a very specific and very dangerous vulnerability for anyone holding leveraged paper gold. If just a small piece of bad news comes out and triggers a little bit of selling, there's nobody there to step in and buy. That can lead to a cascade of forced selling for margin calls, causing a price drop that's incredibly sharp and fast and feels completely out of proportion to what actually caused it.
So, what happens when you put these two completely different market dynamics together? You've got this physical squeeze building in silver and this dangerously crowded trade in gold. How could they possibly interact? Well, this is where it gets really, really interesting.
Just imagine this scenario for a second. Gold has a quick, sharp correction because of its crowded positioning. That bad news sours the mood for all precious metals, so the paper silver price probably drops too, just out of sympathy. But all the while, underneath that surface noise, the physical reality in silver keeps getting tighter and tighter. The vaults keep draining. The delivery pressure keeps building. It's completely ignored by the paper traders who are just chasing headlines and sentiment.
Okay, we've laid out the data-driven case for both silver and gold. So the most important question is, what does any of this actually mean for you, for your own holdings? Let's make this actionable.
Let's just break it down nice and simple. If you hold physical gold, this positioning risk doesn't really affect you directly. The data says you can just hold with conviction. But if you're using leverage in the gold market, that risk of forced liquidation is very real, and you absolutely need to take a hard look at it. For physical silver, well, you're positioned on the right side of this physical squeeze, so it's a game of patience and conviction. And finally, if you're in paper silver like an ETF, you just need to be aware that the fund's price could disconnect from the physical price in a crisis, so you might want to consider if converting to physical makes sense for your situation.
So let's just boil this whole warning down to the 4 bedrock facts driving it. Remember these points. 1. 86% of COMEX registered silver is gone. 2. Record-breaking physical demand is slamming into that depleted inventory. 3. Gold is a crowded trade which makes it vulnerable to a shakeout. And 4. The paper leverage in the silver market is at a historic, all-time extreme.
And isn't that just a classic truth about how markets work? The really big, life-changing moves, they don't happen when everyone agrees and sentiment is through the roof. They happen when the mainstream is looking the other way, when sentiment is in the gutter, and when almost nobody is positioned for what's about to happen. And that really is the whole point of this. It's the central message. You have to learn to tune out the noise, to ignore the day-to-day sentiment, and instead trust the objective, verifiable data. The data is what tells you what's coming, long before the headlines do.
And that leaves us with one final crucial question for you to think about. The data is clear. It's pointing to a physical threshold that is about to be breached. So the choice for every single investor is pretty simple. Are you going to act on that data before the breach happens? Or are you going to be one of the people forced to react after the market already has?